How to escape a bad investment? That's the topic of our discussion in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me, as always, is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
A very basic question to start with. How do you define a wrong or a bad investment?
First and foremost, it could be inappropriate. You are investing for the long run and you are being told something which is for the short run, or your investment is for a short period and you have been advised something which is meant for the long term. And then there could be the really toxic ones, one which hurts, and mostly, they fall in two categories. One is that too good to be true, the kind of rackets which people land into. And it's very easy to believe because somebody in the neighborhood will come and say that he made it, I made it, now you also, and you have missed it. And that
they kind of cajole you into...
Yeah, and you derive the comfort from the people whom you know. And that, the basic question is, too good to be true, it is unlikely to be true. So that's a thumb rule. The moment you get 15%, 18% assured return, you are unlikely to get your money back. Take a note of it. It always happens without fail. Then the other thing is, something which you landed, I came across a joke, that one person walked into a HDFC Bank branch with a gun and 2 lakh rupees in his hand and said that nobody should give me any ULIP, any of those things. I'm here just to deposit my money. So I'm just wondering that, there are active, aggressive salesmen. They have targets. They have incentive to do that, and that is generally trying to meet their objectives, and they are not keen on understanding your needs, the appropriateness of the money, how critical that money is, because inappropriate investment. And normally, if you ask the basic question, what is the risk, what is the return, what is the liquidity, and then any tax break that you get, any investment can be evaluated on these 4 things. If it is too risky, it should yield high return. And then, what is the liquidity? When can you get your money back? And is there any tax? What will be the treatment of the gains? What will be the treatment of any income in between? And will you get any tax? Will you get any tax break when you invest it? So you have variety of and every investment actually can be broken down into these 4 components.
Okay, mis-selling and poor advice is something that you have to be very careful of. The impact, Dhiren, of the wrong investment can be quite devastating. Why? Why is that?
Simply because you lose your trust for future. You stop, the moment you lose trust, then you stop trusting anyone. And then you get into assets which you think will also be inappropriate, but you'll be more comfortable. You end up buying house, you end up buying gold, that okay, nothing happens, it's lying in my locker. Nothing happens, I can see it. It gets me something. Nobody can run away with it. Nobody can fool me with this. So that also can be inappropriate because having financial investment which can beat inflation, which can beat fixed income return, can translate into something meaningful. The other assets, people have the sense that, the tangibility of it, real estate, as if everything else is unreal. But that's not the right thing. Financial investments have a purpose. They combine these 4 variables, liquidity, risk, return, and tax concession in a format which is more desirable and actually more suited for the modern life. You don't have to really worry about it. You don't have to worry about the tenant. You don't have to worry about the transaction costs are low. It's efficient. It's transparent. It's liquid. So those variables, I think, far outweigh. So that is one. You lose trust in the system and miss out on the big opportunity. And then I think, the other is that it's real loss. You invest your money, it's an opportunity loss. It's a real loss sometimes. You invest in an appropriate thing, it is disappointing. And many a times, it is not mis-selling, it is lying. Somebody will tell you something. So I think that is another check which everybody should ask, that people will say that this is what you will get, but it will never be mentioned in the paper. It will be never mentioned in the policy document. So asking those questions, looking for that evidence, looking for and creating a trail, but that is something, very difficult for a naive investor to ask those things when a fast talking salesman is after you.
So it's very important to read that fine print that comes to us. More often than not, we just ignore it. Yeah,
it's so fine that it's unreadable. But you have to ask that, and I think the regulators need to do something here. The benefits and what you pay for should be in bold type. It's too fine to read.
So how does one avoid getting trapped in these wrong investments? Are there any warning signals that we need to be careful of?
No, it's your money. You need to guard it and ask those 4 questions. What is the return? What is the risk? What is the liquidity? And is there any tax rate? And if you don't get tangible answer, keep off. Don't be in a hurry to sign on the check.
Okay. And also recent past performances, what do you think of those? Should one look at them?
Those are usual, they are standard mistakes, but that is not actually a downright fraud. That is not something which lands into, because many a times, it's very normal for people to chase what has happened in the recent past, belief in recency, something which has gone up by 30% in last 1 year. We extrapolate that, okay, if another run for 6 months, we'll still be making 15%. Chasing past performance, avoiding that, not being methodical, once again believing in something which is too good to be true, because even there it is too good to be true.
Sure. Okay. And what role does speculation play in all this? Should one speculate?
It's a human instinct. Everybody wants to, and easy money coming your way. And sometimes, and all in India, it is a particularly very difficult thing, because all other forms of gambling is banned. It's illegal. So the only thing you are left with, this, and here is something where you speculate in the stock market and pretend to be doing some intellectual exercise. You are thinking about a company and you're reading a story or listening to a story, believing in that story, and then something else happens. But you don't know enough, and not knowing enough and putting your money is speculation, to my understanding.
Okay, and should one invest short-term money in equity?
Never. It takes time for companies to build, and it's very difficult to guess the stock market or individual stocks direction in the short term. So it's speculation, it's gambling.
And I've heard you say many times that you should always diversify. Would you like to elaborate on that?
No, those are basic framework.
Just because you don't want to get trapped in a wrong, therefore I'm asking you this.
The thing is that, even if you are not speculating, even if you are investing, but things can go wrong. Businesses have inherent good, high quality business risks. Every business comes with a risk. It can work well, it may not work well, it can get into a cyclical downturn, and just having most of your money in one thing, you are more vulnerable. So spread your risk. And so if you have a lakh of rupees, spread it over 10 of them. All 10 of them will not actually fail. Be in good businesses, invest thoughtfully, be regular. So, these are all checks and balances. These are the operating framework which any investor should be doing. If you can't do all that, buy a mutual fund, do your SIP, that's it. Where everything else is taken care of.
Okay, now that you know what is a wrong investment or a bad investment, you also know what are the signals attached to it. The next question that I have, and I'm sure some of you would identify with it, is that if I'm already in a bad investment, what should I do? After listening to you.
No, that is actually the starting point, because most of the time people end up, they start with something which they did not plan for. So take a stock. It's never too late. Ideal thing is that, you should have checked all those things before getting started. If you haven't done that, take a stock, undo it. Don't lose your trust. Blame it on yourself. Or, it's better to be, taking stock, undoing things, winding up. Many a times, and, having a financial framework that you have your emergency fund, having your term plan, having your health insurance, and then getting started with your investments. Many a times people don't have that priority. All you do is, and, understandably so, you just have, too many needs at the outset when you're getting started with your career. You just don't have enough surplus. Then sometime in February, March, somebody turns up and say, LIC खरीद लो, ये टैक्स का टैक्स बचेगा नहीं तो सारा टैक्स कट जाएगा. So you start less thoughtfully, and then you go. So whenever you are, if you are watching this, take a stock of things and start fixing it.
However, don't lose hope. Let it be a learning lesson.
No point of losing hope, because losing hope will not lead you anywhere. You have to plan for your retirement. You need to be financially independent. Then you have to do it. Whether you like it or not, whether you are financially oriented or not, but you have to do the basics.
The role of the fund manager.
Nobody has a choice as such.
Yeah, the role of the fund manager, Dhiren, comes into play over here while you are looking at your bad investment, so to speak. If he's asking for too much of churn in your investment, should I doubt that?
There are different strategies. To my understanding, most good fund managers don't churn. They are just not active traders. They buy a company, hold it for a long time, and those stocks actually go up steadily, nicely over a period of time, and that translates into the growth. There are fund managers who have succeeded for a period of time, but I haven't seen a very sustained great performance from a fund manager with a high turnover ratio.
Okay. It's time for us to move on to the Q&A part of this program. And my first question to you, Dhirendra, is from Akash. And he says, is it wise to not invest beyond ultra short-term funds for debt portion of allocation? What should be the criteria to choose an ultra short duration fund?
Broadly, your fixed income investment, money for few days, months, non-negotiable, no downside, should be in liquid fund. And liquid funds are going to become even more safer. SEBI has made changes whereby
we discussed it
last time. Ultra short-term bond fund, I think they're good enough. They're good enough avenue. They are no frills. The way to evaluate ultra short-term bond fund is go to Value Research online, look for a fund, and go to the portfolio tab and see the rating breakup. A company with a very high allocation to lower rated bonds, because we have given you percentage, the latest one, that's one. So starting point should not be looking at returns. Starting point of choosing a fund should be looking at the risk there, because for fixed income investor, protecting themselves from a downside risk is paramount. That's the top priority. So look at that. Anything which has more than 30% at below BBB and all, or AA and below is avoidable. That's one. Then looking at consistency of return, and I think you will have reasonable choice there.
Okay. Rohit has written in asking, does expense ratio matter in equity funds? Should I consider it while choosing the fund?
Expense always matters. Because the return that you get is less expenses, and so if a fund has 2% expense, and if you are getting 10% return, the fund actually earned 12% and you are getting 10%. So always look at expense. But the design of the regulatory framework for equity fund is such that it is all predictable. It is mandated by the law, and everybody hits the ceiling. So the rule is that up to 500 crore. A fund is supposed to charge 2%. Next 500, it is supposed to charge 1.75% and then 1.5%. And there are two lines of expenses. These are all for the regular plans, the funds which are sold through the intermediary. There is a parallel track. If you choose a fund yourself, then there is a direct plan, and the expenses are always lower. And the difference in the regular and the direct plan is the amount of commission paid. So if a fund is paying very high commission, the direct plans will be cheaper. If a fund is paying lower commission, then the difference between the regular and the direct will be marginal. So it ranges between 0.5% to 1%, because intermediaries get anywhere between 0.5% to 1%, and that is the difference. So expense matters, but there is one catch here. Don't be guided don't be completely guided by the expense of an equity fund, because the regulation has mandated that a fund gets larger, it is supposed to charge lower fee. And becoming a large fund is also an impediment to performance. Big funds struggle to perform many a times. So you earn more
I know.
if you're small. So in that sense, it's a catch.
So therefore, bigger the fund.
In case of equity fund, don't be entirely guided, particularly in small and mid cap funds.
So should I shy away from such funds?
Yeah, very big, small, very big mid cap fund or small cap fund. One should not be guided by expenses, because being small is an advantage. They tend to do better. The fund manager has a greater flexibility, maneuverability, his ability to make changes and having an impact on the positive impact on the fund performance is meaningful. So don't be overly guided. In debt funds, expense matter, because they're the 0.5%, because these are very narrowly the returns of debt fund is in a very narrow range. So assuming that a fund gets you 10%, earns you 10%, and 1% expense or 0.5% expense can actually be very meaningful part. It could be 5% of the return. In case of equity, sometimes you get 30%, 40%. Some year you don't get as much. But in those kind of performance, that expense becomes relatively meaningless or very immaterial. But it always matters.
Our next question, perhaps everyone or most of us would have on top of our mind, and this is regarding mutual fund schemes which are giving negative returns. How do I decide whether to exit that fund or not? This has come from Shailesh and from a whole lot of others who are listening and viewing this program.
This requires, it's a very complex question, because the answer could be different for different kind of fund. Many investors got excited about markets in 2017 and they invested, and 2018 turned out to be a very devastating year for equity, and even now it is not going anywhere in a hurry. So a lot of people are getting disappointed. But 1.5 years time frame for equity investment, is it time to really quit? No. Likewise, in fixed income funds, some funds suffered with the rating decline or the poor credit. There the funds have been earmarked, they have been marked down by 5%, 7%. You have seen a 5%, 7%, 8% decline in about 20 funds. But that money has not disappeared. That money is subject to some resolution. So don't get out of those funds in a hurry. There is a third situation where you landed into a fund and you just looked at the recent performance. You got attracted to it, and it is not working out to be. It is not as expected. You are just not. It was just the inappropriate thing. Take your money out. Get thinking about how you should be investing. Be methodical about it. Most of the time, and when such investors invest, they saw the 2017 return, got excited about it. Then you invest 5 lakh rupees, and that 5 lakh rupee going down by 10% is quite unnerving, because then you start relating it that, oh, this is my 2 months saving, or this is my full month salary. It takes so much time to, you work hard to earn that, and then you lose it in 3 days. So, having a calibrated plan, being methodical about it. In fact, it is a kind of market where somebody should be feeling happy when the market goes down only if you have a regular investment plan that you are buying cheap. And that takes, 5 to 7 years for people to understand that how long-term investing works, how being regular helps. Before that, because once you have accumulated 5 lakh, 10 lakh rupees, by following that plan, then you realize that what it is. Having 1.5 times more return than fixed income, or twice as much as fixed income, accumulation of that investment, and then appreciation. Before that, people don't understand that. So you have to discipline yourself with this. Use this as an opportunity to work on a plan.
Okay. How important is rebalancing one's portfolio? This has come from Arjun.
Very important, because most people are very passive about their investments. Like they do their SIP and forget about it. Nobody has thought about their allocation, because but as you get closer to your goal, or as you get older, your risk tolerance comes down. You start worrying about that. A 15% decline could be quite unnerving for many people. That's the time when and so rebalancing is deciding on an asset allocation, assuming that an old person retires and he has sizable money, and he decides to invest half of it in equity, half of it in fixed income. Equity does poorly, so 50% becomes 45%. So 45% now, if you have to rebalance it, you will move money from fixed income to equity to balance it to 50-50 once again. The moment you do it, you are buying cheap and moving money. And typically, if you do it annually, it can be done with a great efficiency. And this is a method which I think, enhances your return quite meaningfully on any time period.
Do you need the expert advice of any person to rebalance? Because if had I known that this is going to happen, I wouldn't have invested or remain invested in a.
That requires magic or an astrologer to know beforehand what will happen. But this is something which you have to really understand that fixed income goes up steadily, and equity goes up, generates more return than that, but it generates the return in a very erratic manner. So how to profit from this? Most of the time, people run away when the market fall, and they start investing with great confidence when it has already gone up. You are doing a reverse of it. You are investing when market has slipped and actually moving money out from equity when it has gone up. So in a way, you are doing it, but with a method.
Okay, right. How can I calculate the ideal amount of life insurance cover for myself? And this has come from Anshul.
I don't have a precise rule, or there isn't a formula, but I would say that 8 to 10 years of income requirement, current income requirement, is the term cover that you need. So if your monthly expenses is about 50,000 rupees, so you spend 6 lakh rupees in a year. So I would say that 60 lakh rupees cover should be good enough.
Okay. Sri Rama writes, which category of funds would be suitable to save for my retirement, mid cap or small cap? I have 23 years to invest for it. Thinking ahead.
Before that, I would like to correct my previous answer.
Okay.
Not the income requirement, but your actual income, because your income also factors in your income that you spend, and the savings which will translate into your need for which will take care of the future needs, so your retirement accumulation and other things. So it's not monthly spending, it is monthly income that you depend on, because that is something which will disappear if you are not there. So annual salary into 10 is a broad thumb rule, but it can vary for different people depending on the kind of complexity of dependence. If you have old parents dependent on you, it could be different. If you have more than few children or other dependents whom you have to take care, but it requires careful planning. But I would say that broadly, if you have that in place, it should be okay.
So coming back to Sriram's question, mid cap or small cap with 23 years of horizon?
To begin with, it entirely depends, because as I was telling you, the context of the discussion, that how to escape bad investment. Small cap, mid cap, they all are okay. They generate decent return, but they come with, two things are very critical in any investor's initiation to investments in equities, which is how critical is that money, and then is the experience. So if you are not experienced, don't even think of small cap, mid cap. Start with a balanced fund. Do it for 3 years. If you have been in the market, if you have been investing for a while, then do it with a multi-cap fund, which will have large cap, which will have mid cap, which will have small cap. Because I'll just give you the context of this. 2008 happened. Large cap funds fell by 45%. That was very disappointing. But small caps slipped by 80%. When your 100 rupee becomes 20, though it remained there for just about 8 months, but 100 rupee becoming 20 is that it makes you disinterested. You just get out of the market, stop looking in that direction. You think in terms of bahut ho gaya. That is something which is so, and then you miss out on the big opportunity, because after that the market has gone up by 5 times on the small caps. Next 10 years has turned out to be far more rewarding. The market on the Sensex is twice as much, though not significant. It's not a meaningful return. 10 years doubling of money is not great return. But investors have missed out, who were new investors who started with racy funds in 2008. So keep off from this, follow a method, have a hierarchy, get into, it's like it's going on a voyage, and you have to make sure that you are doing it in a manner that you are not drowning in the initial phases.
That's all we can take in today's program, Dhiren. Thank you so much for answering the queries and throwing light on how to escape a bad investment. Signing off, I'm Rajesh Lake and Dhirendra Kumar with an advice to invest wisely but regularly at the same time. Till we meet next time, goodbye.